Hello, everyone, and welcome back to Accounting with Oscar. Now, thank you all so much for watching my commentaries, for liking my videos, commenting, and subscribing. Now, thank you all so much. It's been a joy, and I really love interacting with each and every one of you. So, thank you all so much for leaving down comments. Thank you all for subscribing. Well, we're still a small little family here, and I do plan on keeping it that way. Let's see how it goes. Alright, so today I'm back with another commentary video, and I believe some of you have been asking me for this, so we're gonna do the 2025 February March paper 1. Right, so this just came into me this morning. It was fresh out of the oven. So we're gonna have a look into the accounting, right? Accounting paper 1, multiple choice, February, March 2025. So we have about an hour and 15 minutes. That's about 75, right? It's about 75 minutes to attempt a total of 35 questions. So if I were to do the math for you, that would be about, let's say, 2, right? So that'll be about 2 minutes per question. That's what we're going to take. We're going to try to attempt every single question in under 2 minutes. So you're going to use the remaining time to do your double checking later on. Right, so I presume 35 questions. You take about 2 minutes each. At least you would have used up only 70 minutes, right? So you can leave about, say, 5 minutes to do your checking, or even more, because not all the questions would take up about 2 minutes. I mean, you go on average, right? There's bound to be some easier questions, some tougher ones, and some which are just in between. Well, we call that level 1, 2, and 3. But anyhow, let's jump into it. So once again, are you allowed to use a highlighter? Well, go ahead, right? Go ahead. You can use a highlighter because, well, they're not gonna mark this question paper, right? They're gonna mark your answer sheet. So it's all right. You can go ahead, highlight some important points if you want to. If it helps you, go ahead. Right, so let's jump into the first question. So a business employs a bookkeeper and an accountant. Now, which task does the accountant perform? So this goes back to your basic knowledge of accounting, whereby we understand that the bookkeeper does more of recording transactions, right? So if I actually bring you into a flow chart, this is how the whole process of accounting is gonna look like. So we will always start out with documents. So documents are the source of double entries. So we're going to start with documents whereby all the information contained is going to be summarized, right? We're going to summarize the information in the documents into what we call the books of prime entries, or some of you may refer to them as the journals, right? So we're going to summarize some financial information into the journals, and from the journals we're gonna start bringing the totals over to the ledgers, right, to your T accounts, and from the ledgers is where we start balancing things off to work out our trial balance, a list of ledger balances, and from there is where we're gonna start to draw out the income statement as well as the statement of financial position. Right, so that's the entire flow of accounting? Well, bookkeeping and accounting, right? So where does the bookkeeping process end and the accounting process start? It's right here. So whatever we are doing up to the trial balance, now this portion is what we call bookkeeping, right? So it's more of trying to record transactions as well as to summarize them. Now, the part where we actually get the financial statements out, the part where we actually start analyzing, that is called accounting. So, extracting balances from the ledgers to prepare a trial balance, this is still bookkeeping. So, you're summarizing things up. Making a journal entry to record the credit sale of a non-current asset. No, that's still bookkeeping. Now, preparing a monthly report that analyzes the profitability of the company. So you're moving on to a report. Now that is what you call accounting. Recording sales and purchases invoices in the books of prime entry, that is still bookkeeping, right? That's the second process. So there you go. Now let me bring you over to question 2. A transaction has had the following effects. So there's a decrease in asset, a decrease in liability, and an increase in capital. The business is not overdrawn at the bank. Now, which transaction has happened? Right? What caused your assets and liabilities to decrease while your capital actually increase? So what I'm going to do here is quite simple. I'm going to analyze through every single option I have and look at their effects. So for option A, a payment was made to a credit supplier after taking a cash discount. So I made a payment. That means my bank balance would have reduced, so asset reduced. Paying my supplier, so at the same time reducing my liabilities after taking a cash discount. Okay, so I earned a cash discount, so that is a form of other income. So other income is going to increase my profit, which in turn increases the capital. So option A looks pretty good here, but I'm just gonna analyze the rest just to be really sure. A payment was received from a credit customer, so that's money in. So increase assets, right? Payment received from a credit customer. So you increase your assets at the same time you reduce them again. So basically it knocks off. There's no effect to assets, right? So you debit your bank, credit your receivable. It's gonna neutralize things. So no effect to assets, no effect to liabilities after allowing a cash discount. So here we took a discount, here we allowed. So I gave a discount. That would reduce profit, which would reduce capital. So B is not the right option. C, goods were sold to a credit customer for less than their cost price. So I'm selling for less than cost. Very obvious, I'm making a loss here. So this reduces my capital. So when I sell for less than cost, what happens? I'm gonna reduce the value of inventory by so much, and the value of my receivables only increase by this little. So all in all, I'm reducing the value of assets with no change to liabilities. So that's not the right answer. We're not going for that. Now let's look at D. Goods were sold to a credit customer for more than their cost price. Right, so this case, I'm finally making a profit. Capital increases. Assets would increase as well. But again, there's no effect to liabilities on both transactions. So makes a clear cut. The answer is A. So we just have to analyze through different scenarios, just gotta work them out in your head, do some trial and error. Well, I won't call it trial and error per se, it's still an analysis, right? Now, let's move on to question 3. The double entry system of bookkeeping consists of processing accounting data in a certain order. So what is the correct order? Now, I already have my answer. It's right above in my flowchart. So I start off with documents, right? A lot of information in the documents. Some are not necessary for an accountant. So what we do is we summarize information into the journals. Then we do totals, bring the totals over to the ledgers, work out a trial balance, and then finally you get your financial statements. So I start with documents, right? Don't start with the journals, start with documents, move on to the journals, not the ledgers, right? Only go to the ledgers once you're done with the journals, and finally the trial balance. So A would be your answer. Now that's one reason why I love the flowchart. It helps a lot, right? I believe it helps to some extent. Right, so let's bring you on to question 4. Imran made an entry on the debit side of the cash book in the bank column. What could the corresponding credit entry represent? So you made a debit entry in the bank column. You debited bank. So what is your credit entry? Now this question looks hard, but the principle is actually very simple. You just have to tell me what is a possible credit entry. What can be possibly credited? So I could credit an increase in liability. I could credit an increase in capital, or I could credit an increase in income, right? There's also a possibility it's a reduction in asset or a reduction to expense, right? So there are 5 possibilities here. A decrease in cash, right? So cash is an asset, reducing asset. Yeah, I think that's a good credit entry. Decrease in payable, reducing liability. Now that should be on the debit side. Increase in non-current asset. No, that should be on the debit side as well. Increase in trade receivable is an asset, still on the debit side. So the only credit entry that's possible is a decrease in cash. Now I know what some of you are gonna think. You're gonna think, Oscar, is it possible to have 3 A's in a row? I mean, sometimes you have that psychological feeling, you get too many A's in a row, you think, no, that's not the right answer, you would have done something wrong. But all in all, just goes to show, right? There's no solid statement saying that it has to be a mixture of A, B, C, and D, right? No one says it has to be equal, 35 divided by 4 No one says that there has to be like 9 A's, 9 B's, 9 C's, or 9 D's. No, I can give you like 15 B's, why not? Right? So don't doubt yourself, just do what you think is right? Just do you. So let's go to question 5. Dave supplies goods to Peter on credit. On 1st of April, Peter owed Dave $440. Now, during the month of April, Dave processed the following documents. On April 7, there's an invoice issued. April 12, there was a check received after Peter deducted $11 cash discount. On the 13th, a debit note was received. And on the 15th, a credit note was issued. Now, the question is simple. What was the closing balance on the statement of account issued by Dave to Peter on 30th April? So we have to calculate how much Peter actually owed Dave at the end of the month. So it's a matter of plus minus. You don't really have to work out the entire ledger here. We can do basic math. So at the start of the month, I owe you $440. Invoice was issued, so this increases the amount owing. Check received, so a payment was made, that reduces the amount owing. So we have to deduct the cash discount as well. Now, right after that, you're gonna see two things here: debit note received and credit note issued. Now, I was reading through some comments from students who sat for this paper. Some of them were confused as to why there was a debit note and a credit note. Some people plus minus, some people minus minus, right? Some even went to plus plus. So here's how it's gonna look like. Do you remember the process of doing a return? Right? So if I bought goods from you and I feel that there's something wrong, maybe it's a damaged product, or maybe, I ask you for pregnant penguins, God knows why, okay? Maybe I ordered pregnant penguins from you, and when the penguins came, they weren't pregnant, so I was not satisfied. I want to return the penguins. So what I do is, first things first, I will raise a return, right? I will try to request for a return. Now, that is the function of your debit note. You try to request for a return. Now, that's not the final confirmation, because the seller would then issue a credit note as a confirmation that your return has been accepted. Okay, so that's how the whole return process works. So your debit note is actually issued by the buyer and your credit note issued by the seller. So both are actually recording the same transaction. Only thing is, one of the document is a request for a return, while the other is a confirmation of the return. So what I'll do is I'm gonna ignore the debit note. We ignore this because this is not the final confirmation, not the final document. I will only deduct $50 once. I'm not gonna do it twice. So after you've done all your calculation, plus 360 minus 429 minus 11 minus 50, you should be left with a balance of $310. That is your final answer. Let me move on to the next question. Alicia entered the credit notes she received in March in the correct returns journal. How was the total of this journal recorded in the ledger at the end of March? Now, some of you might get yourself confused when you're recording credit notes. Now, the important thing here is not the document itself, but the point of view of the document. So right now, this Alicia, she's receiving the credit notes. So I'm receiving a confirmation for my return, which signifies that this is actually a purchase return. If this was a sales return, it would refer to credit notes issued by Alicia, right? But now she's not issuing them, she's receiving them. So this is actually a purchase return transaction. So purchase return, what do we do? This is a reduction to expenses, right? So I'm going to credit the purchases returns account. It's as simple as that. Moving on, which statements about trade discounts are correct? So there are two different types of discounts in accounting. There's a trade discount and there is also another one called a cash discount. So you need to be able to differentiate one from the other. Statement 1, it is debited to the supplier's account. So debited to the supplier, you reduce the payables amount. Is it true? Well, it would be true if this was a cash discount, right? But if you're talking about a trade discount, it's false. A trade discount never appears in the ledgers. You have to remember that. So trade discounts are usually accounted for within the invoice itself, right? Accounted within the invoice. So usually when I give out trade discount, it would be for bulk purchases or if the customer is in the same trade that I am in, right? So the same industry. So what I do is the moment the customer purchases from me, I will know whether this person actually qualifies for a trade discount or not just by looking at the quantity they are purchasing or looking at who's the person, right? So I can adjust for it in the invoice, which will naturally reduce the sales or purchase value. So it never appears in the ledgers, it's never adjusted there. Only a cash discount would appear in the ledger. Now, why is that so? Because we never know whether a person qualifies for a cash discount until they actually pay up. You know, you can't just assume people are going to pay you early and you give them discounts. I mean, that's a terrible way to run a business. Okay, now it's only given if the invoice is paid within the period allowed by the supplier. Again, this is describing a cash discount, right? You pay early, you get a discount. So 2 is out. Now the answer should be straightforward. It's actually 3 and 4. So it's shown as a deduction from the price of goods on an invoice. Now this is an accurate description. It's used to encourage bulk buying. Yes, that is true. So 3 and 4 would be your answer. Question 8. Why is a trial balance prepared? Okay, what's the purpose of preparing a trial balance? Why do we want a list of ledger balances? To analyze financial information? Well, probably not, right? To analyze information, I would maybe look at trends or ratios, but not a trial balance. To assist in the preparation of financial statements. There you go, that's your answer, right? So you're going to transfer whatever information you have in the trial balance into your income statement and financial position. To control the cost of the business, probably I would come up with some costing sheets or maybe analyze the expenses column of the income statement. No, but I wouldn't use a trial balance. To evaluate the performance, that will be more of the financial statement once again. So using the income statement or statement of financial position. Question 9. Which group of account balances would appear in the credit column of a trial balance? So credit column, asset equals to capital plus liabilities. Asset is on the left, that's on the debit. So capital and liabilities, that will be on the credit. So assets is wrong, purchase is wrong, drawings wrong, A is definitely out. Discount received, that is a form of income. Income is on the credit side as well, that is correct. Capital is correct. Sales return is a reduction to income, so that appears opposite, it's on the debit, no good. Liabilities good, no. Expense no good. Sales good. Right, sales good, capital good, purchase return is a reduction to our expenses. So that is on the credit side. That is good. So D is the correct answer. Now let's move on to question number 10. Now, Arnott's draft profit for the year was 17,000. Okay, that's the draft profit. His actual correct profit was 17,400. So which error had been made? You see, they always come up with different ways to try to test you on correction of errors, and this was just one of the new ways they actually used. So we know that a $400 error was actually made. So the actual profit was higher by 400. So initially the draft profit was understated, right? $400 understated. So once again, there's no other way I can do this except to go through each and every option. So let's get started. A purchase invoice for 2006 was recorded in the purchaser's journal as 2002. So expenses were understated. If expenses were understated, that would actually lower the profit even more. So instead of 17,000, my profit would have been 16,600 if this was the case, right? Whereby I reduce my profit by another 400. So that's not a good option, right? Minus 400, no good. A sales invoice for 2006 recorded in the sales journal as 2002. So income understated, right? That means my profit is understated. So when I make a correction, the profit should increase by 400. So I believe B is a good answer as of now. Discount allowed of 400 was posted to the credit side of the discount allowed account. So instead of recording an expense, you went ahead and treated this as a form of income, which is clearly not the case, right? So in order to reverse the credit side, you have to debit discount allowed. So I'm going to reduce my profit by a total of 800 to remove the credit and to record the debit. So that's entirely a wrong figure. Now, option D, discount receipt of 400 was posted to the debit side of the discount receive account. Supposed to be an income, you treated this as an expense. So what I need to do is I need to increase the profits back up by a total of 800. So remove the debit, record the credit. So again, that's entirely a wrong figure. So B will be my best option. Right, so how does it feel after going through 10 questions? I mean, you would see some of them are somewhat repetitive from previous sessions. So I wouldn't worry too much about paper 1. As long as you have enough practice, you have enough past years, I'm not worried, right? You should be able to make it through. Now, if there are anything you don't understand, yeah, there are. Okay, good grammar, Oscar. If there is anything you don't understand, leave a comment down below. If you think I gave you a wrong answer, leave a comment down below as well, right? Or if you just want to interact with me, if you just want to stay for a chat and maybe some virtual coffee, then here's a matcha latte for you. Okay, now, question 11. Paul calculated his profit for the year to be 40,000. Paul then discovered the following errors. The expenses included rates prepaid 1,000 for the following year. 600 owed for electricity had been omitted. Sales returns of $10,000 was not recorded. So what was the correct profit for the year? Very simple. You only have to understand a few principles here and you're good to go. Rates prepaid. So these are not incurred but paid in advance. So if they are not incurred, they will increase our profit back up, right? So reducing the expenses. 600 owed for electricity. It was owed, right? So it's been consumed. That case, we have to reduce the profit by 600. Sales return not recorded. Sales return reduces your income, so you reduce by 10,000. So 40 plus 1 minus 600 minus 10,000. You should get a corrected figure of $30,400. Alright, question number 12. The totals of Simon's trial balance did not agree and he opened a suspense account. He then found that he had restored the impress with $70. He had recorded it correctly in the petty cash book, but had recorded it on the wrong side of the main cash book. This was the only error. Now, what was the opening entry in the suspense account? I know you guys hate this so much, right? Probably some of you really hate this because, correcting error is one thing, but trying to reverse everything to go back to the original suspense account balance, that's not easy. Right, but you have to be, you're lucky you only have one error, If you have like two errors, this is gonna get complicated. So, okay, restart the impress on the petty cash, right? What's a double entry? Restoring the impress. Probably I debit petty cash by $70 and I would credit cash or bank, right, by $70. So what they've done here is they recorded the entry correctly in the petty cash book, but on the wrong side of the main cash book. So instead of crediting cash, they would have debited cash $70. So the debit side will then be overstated by 140. So we need to balance the credit side. So you need to balance the credit side by $140. So need to credit suspense 140. So your answer would be C, $140 on the credit side. Question 13. Jamal's bank statement at 1st of May showed a bank overdraft of 1,460. At that date, there were unpresented checks of 385 and uncredited deposits of 255. So what was the cash book balance at 1st of May? So this will be a simple bank reconciliation question. To work on bank reconciliation, I have my own way to do it. I mean, probably you have your own way, but I'm gonna do it my way. Okay, sorry, Frank Sinatra heading in. Okay, sorry, I can't sing. Well, okay, probably I shouldn't say Frank Sinatra. My God, you're gonna get my age. Don't guess my age. Okay, I'm still young and vibrant. Okay, so what I'm gonna do is I'm gonna start with the balance per bank statement, right? So balance per bank statement, I have 1,460. It's an overdraft, so I'm gonna make sure I indicate that. So I'm trying to reconcile to the balance per cash book. Now how I'll do things is that I always look at the endpoint. I'm trying to agree to the cash book balance. That means I'm trying to work towards the perspective of the accountant. So I will follow what the accountant has done. Unpresented checks I have issued, but the bank has not cleared. So what the accountant will do is they will deduct unpresented check the moment it's paid out. Uncredited deposits, probably I deposited a check or probably I deposited some cash, but the bank hasn't cleared it. Well, as an accountant, I will add the moment that I've deposited, right? So remember, as an accountant, we will adjust for transactions straight away as they occur. So I will follow the point of view of the accountant, follow their footsteps, and I will end up with a figure of how much? $1,590, and this would be a negative figure. So it's an overdraft. It appears on the credit side. So that's one other thing to look out for. Right, so that's bank reconciliation. Simple as that. I don't know why some people find it tough. I mean, probably you don't look at the point of view of the endpoint. I don't know, right? But because I apply this, it makes life so much easier. When I teach bank recon, people get it. People love it. So I don't understand why some of you hate bank reconciliation, but yeah. Okay, well, let's analyze question 14. Which items are included in a sales ledger control account? So sales ledger control account refers to the receivables control. Goods returned by credit suppliers, does that appear? Goods returned, yes, but how do you get a return from your suppliers? That's not possible. This should be returns from customers. So one is out. Debts that have been written off as irrecoverable, that would be correct. So you have to credit the receivables. Goods sold for cash, no, they don't appear in the receivables control because they are not receivables. checks received from credit customers and returned by the bank as dishonored. That is correct. So when you have cases of dishonored check, you have to debit the sales ledger control to increase the receivables balance back. So 2 and 4 would be your answer. Question 15. After preparing his financial statements, John T discovered 2 errors had been made in his accounting records. Error 1. Vehicle repairs cost of 1,005 was debited to the vehicle's account. Okay, so we made a little error of principle there. Supposed to be an expense, but we recorded it as an asset. Well, I know the question never asked for it. I'm just telling you more. Right, so legal fees of 2,100 relating to the purchase of new premises was included in expenses. Ouch. That's another principal error. So, you see, when you talk about legal fees, right? These are part and parcel of your new premise. So it's actually incidental, right, to purchasing the premise. If you don't incur legal fees, you may not be able to buy the premises. You may not be able to use the premises. So it's considered part and parcel. That's why we would usually capitalize the legal fees. So this part of the legal fees will be recognized as capital expenditure. So it's a part of asset, not a part of expenses. Okay, so ignoring depreciation, what was the effect of these errors on John T's profit for the year? Alright, so error 1, you included repairs costs in your vehicles. That means to say your expenses were understated, so you did not record expenses. That will leave your profit being overstated by 1,500. Okay, that's error 1. Error 2, these legal fees were included in expenses, which it shouldn't have been. So expenses were overstated. That means to say the profit is understated by 2,100. So all in all, your profit would be $600 understated. Alright, so that's 15 questions true. I think we're moving on well. Question 16. Which item is a revenue receipt? So this is where you have to understand the difference between capital receipt and revenue receipt. Capital receipt is more of a one-off thing, right? So if we talk about capital receipt, this is more of a one-off thing, more of a one-off transaction. Doesn't happen regularly, right? So it's not in the ordinary course of business. Well, not the day-to-day operations at least. But if you talk about revenue receipt, then yes, this is money received with regards to the day-to-day operations of the business. So they are usually what we call recurring transactions. So option A, cash invested by the owner of the business. Is this something that happens regularly? No, so this would be a capital receipt. Proceeds from the sale of a non-current asset. Again, it's not something we do every day, not something we do every week or every month, Alright, it's not going to be a recurring process. So that's capital expenditure, capital receipt. Rent received from letting out part of the premises. Yeah, so you sublet your property, you get rent every month, right? Now, this is a recurring transaction. It's part of the day-to-day operations. So C would be our best answer. Short-term loan received. No, this is capital, right? It's not something that happens regularly. Question 17. Samuel started his business on 1st of January 23 and bought 2 delivery vans for $12,000 each. He depreciates all vehicles at a rate of 10% per annum, calculated monthly using the straight line method. Right, so a lot of things to digest in the first para. On 1st April 2024, he sold one of the vans and replaced it with a larger one costing $24,000. What was the balance on the provision for depreciation of motor vehicles account at the end of 31st December 2024? Right, so a lot of information to digest here. We're going to break this down one by one. There are 3 vans in total, right? 3 vans involved in total. So there were 2 that you bought in 2023 for $12,000, right? Depreciate 10% per annum, straight line basis, and calculated monthly. So you have to do a pro rata, right? So they want the balance on the provision for depreciation. So I'm going to start with van 1. Bought for $12,000, depreciated 10% per annum for 2 years, 23 and 24. So this leaves me with $2,400, right? Balance on the provision account. Van 2 was sold. He sold the van in April 2024. Now, if you have good knowledge of depreciation and disposal, you will be able to tell that once an asset is sold off, you will zeroize the provision for depreciation account. You're going to write off everything to the disposal account. So the balance for van 2 would actually be 0. Right? For van 3, we bought this in April 2024 for $24,000. So I have to do a pro rata. April to December, that's a total of 9 months, right? So I'm going to do a pro rata of 9 out of 12. So this will give me a balance of how much, right? How much do you get here? It should be $1,800. So when I add both of them up, I'm going to get 4,200. Right, so don't go and do a depreciation for van 2 because it's sold off, right? Don't waste your time. It's sold off. The balance would have been 0. You would have transferred everything to the disposal account. Alright, so I'm gonna stop this video here as a part 1 because it's getting a bit long. So I'll see you in the next video where we're gonna go through questions 18 to 35, right? So if you have any questions, leave a comment down below. If you find this video helpful, make sure to like and subscribe, right? Share this with your friends. Yeah, subscribe, okay? So you get all the latest updates whenever I post something new. Okay, so yeah, I'll see you guys in the next video. Goodbye.